the difference between currency and money, and I've been pounding the table on this since 2006. Currency has to be a medium of exchange, a unit of account. It's got to be portable, durable, divisible, something called fungible. Fungible means interchangeability, like if you loan me a $20 bill, I can pay you back a completely different $20 bill, or I can give you a 10, a 5, and 5 ones. You don't care as long as you're paid back any $20. That interchangeability is fungibility. But money has to be all of those things plus a store of value. And if you're paying for something and it costs you twice as much this year as it did last year, you are paying with currency, not money. Money can store value over long periods of time. Currency cannot, by its very design, store value over long periods of time unless we're going into a deflationary implosion. And then it's not a long period of time anyway, but it will actually increase in value for a short period of time. The difference between what I call honest money so far is gold and silver. These are the only things that throughout history, if you look at the last 5,000 years of mediums of exchange, the predominant medium of exchange has been gold and silver. I've got an old Pegasus coin from 500 BC on my desk, and you can melt that down, and the silver in it has purchasing power. Now, it'll bounce up and down in purchasing power depending on how in favor or out of favor gold and silver are, but they never, ever go to zero. They bounce up and down in this purchasing power range. And right now, they're very low in that range because we've come up with all these different other forms of paper wealth. There's paper dollars, there's stocks, there's bonds, there's just all these different places that you can actually store your purchasing power in. And then there are these moments in time where the population gets scared and everybody rushes back to real money as a safe haven, and their purchasing power increases astronomically. In the bull market of the 70s, gold went up 25 times its initial price, and this was 8.5 years. And silver went up 41 times. That was actually the biggest bull market in history to that date. Cryptocurrencies have been bigger, but the gold rush of the 70s was the biggest bull market in history. Now, the difference between currency and money, honest money, when you make a transaction, you're trading something for something. It's honest, it's fair, it's not fraud. To create a gold coin, there's a whole bunch of time and effort put into prospecting, finding a claim, turning that claim into a mine, mining the ore, refining the ore, and pouring it into gold bars and melting those bars and minting coins. For you to acquire enough coins, say to buy a house, you put in an equivalent amount of work that at whatever pay scale you're at equals the amount that it took to make that coin. Otherwise, they won't make the coins. And then you buy the house, and the value of the house, the time and effort it took to dig up the dirt, to make the copper for the plumbing and wiring and refine that, and the cement for the foundation, and cut the trees and turn them into timbers to build the house. That work equals the work that you put in, which equals the work that the miner put in to create the gold. So it is a fair transaction of equal values. With currency, you go into the bank, you say, loan me something, and they imagine this into existence, diluting the existing currency supply and transferring wealth from anybody that's holding currency to this newly invented currency. So that's theft. And then you're going to buy a house with nothing, and you're going to get something for it, and that's fraud. And so that's the difference between honest money, gold and silver, and fiat national currencies. If you're in a decade, let's say your home doubles in price, did it double in value? Well, if you're going to measure it against other real estate, absolutely not. It didn't go anywhere. If you sell it, you could buy one about the same in the same neighborhood for the same amount of dollars or whatever you're measuring it with. If you're measuring it with money, gold and silver, or if you're measuring it with barrels of oil or groceries or gasoline, if you sell that house and you can buy twice as much groceries and gasoline with it, or shares of stock with the proceeds from selling that house. But if over a 10-year period of time, let's say, the house doubles, but the stock market quadruples, That means the house doubled in price, but its value compared to stocks fell by 50%. Because when you sell the house, you could only get half the amount, the shares of stock that you could have gotten if you had just spent the currency. Even though it was half the amount of currency, you would have gotten twice the amount of shares of stock. The same thing goes with, like, if inflation is raging, your house doubles in price, and you sell it, and all the groceries and gasoline have quadrupled, you can only buy half as much. So the house doubled in price, but went down 50% in value while it was doubling in price. That's the difference between price and value. Asset classes, gold, silver, oil, stocks, real estate, and several other things, going back into the 1800s, so more than 100 years worth of data. And what you see is that when you measure stuff with other stuff, nothing goes up permanently. Everything appears to go up in price. It keeps on going up and up and up. I mean, a house back in the Great Depression, a single family median price home might have been $2,500, $3,000. Now it's $300,000. So it's 100 times higher than it was then in price. The house actually, though, for the number of work hours it takes to buy that house, has actually gone down. This is the currency changing, not the house. The house didn't change. Everything runs in these waves and cycles. One asset class outperforms another one for a certain number of years, and then one becomes too overvalued, the other becomes too undervalued, and they switch and get a bull market. It's gold and silver's time, basically. You know, they had that bull market in the 70s, and in the middle of that bull market, there was a huge correction, a mid-cycle. This is a secular bull market. So it rose up to the end of 74 and then 75 and into mid-76. It pulled back by 50%. It rose to 200, pulled back to 103, and then took off. And in the next just few years, it went to 873, actually, was the intraday high. And so then it went into a 20-year bear market. Well, we're in this very, very long secular bull that is larger in both magnitude and in time than the one in the 70s. And we've been in a pullback. This mid-cycle correction now has lasted since 2011. It's getting a little bit boring, but this huge shift from other asset classes into gold and silver, that started in 2000 and it continues. I consider it one big cycle. And one of the things that I was determined to do when I started down this road is not to let the bull buck me off of its back. So even through the mid-cycle correction, I've just stuck in there and added to my position, and I will continue to do so. And I have a feeling that over the next just few years, 1, 2, 3 years, that we're going to see some huge rewards, especially as we go into the next crisis. And there is a crisis coming because you can't manipulate the economy as much as they have and distort it as much as they have without consequences.